Hi, welcome to this tutorial. So, on the previous tutorial, we have discussed about the financial statement analysis. So, in this today discussion, we are going to discuss about the financial ratio analysis and also about the liquidity ratios. So, let's get started. Financial ratio analysis is a powerful tool used to analyze companies' financial statement. It involves calculating the relationship between two different numbers to uncover trend and access a firm's financial health. Financial ratio analysis mainly is the comparison between two values in the financial statement, whether it is from the same financial statement or a different financial statement. A single ratio is just a number. Its true meaning comes from comparing it to past performance or industry average. We are just calculating a number is just a number only. If you are comparing that ratio, that number with our previous performance, our industry average, then we can get a meaningful insight into financial data. There are different stakeholders for financial ratios like creditors, investors, and management. For the creditors, it is important to evaluate company's ability to repay its debt and its liquidity. Even for the long-term creditors like bondholders, they are focused on the solvency and ability to pay company's long-term debt. For the investor, it is very important to assess company's performance and firm's long-term earning power and assess risk of their investment. This analysis is more in-depth because they bear the residual risk. For the management, it is very important the ratio analysis to monitor the performance, identify inefficiencies, and measure result against the budget and improve the performance. So this is some of the uses of the financial statement analysis. There are different type of uses are there. So these are the key stakeholders or key uses of financial statement analysis. There are some rules or thumb rules for ratio calculation to ensure the consistency and comparability across the organization or across the industry standard. There are some thumb rule or important rule we have to follow when analyzing ratio analysis. First of all, the use of average balances. For example, if you are evaluating or preparing a financial ratio with using one value from income statement and another value from the balance sheet, it is better to use average of balance sheet item because balance sheet is representing a point of time, but the income statement representing a period of time. So to match these two periods, better to use or you should use balance sheet item always average. For example, if you calculate return on asset, you should use the average total asset for the period instead of using a closing balance of the asset. Better to use opening balance plus closing balance divided by 2. So you will get the average of total asset. The other thumb rule, analyze partial periodic income. If an income amount in a ratio for a period is less than a year, for example, you are taking an income statement item that is less than a year, so it must be analyzed to represent full year performance for a quarterly income amount. For example, if you are getting data from a quarterly income amount, it should be multiplied with 4 to analyze it. So these are the key important rules we should follow when preparing financial ratios. Now we are moving into categories of financial ratios. Financial ratios are categorized into 5 categories mainly. First one, liquidity ratios, leverage ratio, activities ratios, and market ratios, also profitability ratios. We can go one by one. First one, liquidity ratio. What it mean by liquidity? Liquidity means it's a firm ability to pay its short-term obligation by using its short-term assets. This ratio measures a firm's ability to meet its short-term obligations. They assess sufficient of a company's most liquid asset to cover its current liabilities, which means simply it's measuring if the company have efficient current asset to meet its current liabilities. This is liquidity, which means it's short-term solvency. So when it's come to leverage ratio always focusing on long-term solvency. Liquidity ratios focus on short-term liquidity once, but leverage ratio focus on the long-term solvency. That means if company have some long-term debt obligations, so this leverage ratios analyzing whether the company is able to meet this debt obligation once it is due. They examine the mix of debt and equity used to finance company's asset and assess its capacity to cover fixed financing charges like interest and lease payment with its earning. The first thing is the repayment of long-term liabilities like loan repayment and other liability repayment. And also there will be always an associated fixed financing charge related with this long-term capital like interest and lease payments. So the leverage ratio or capital structure and solvency ratios is always analyzing the ability to pay its long-term obligation like long-term loan and other long-term obligation. Also its ability to pay its financing charges like interest and lease payments. So this is about leverage ratio. So when it comes to activities ratios, it's also called efficiency ratios. These ratios provide insight into how efficiently a firm is managing its assets and liabilities. Activities ratios is mainly measure the operational efficiency or activity efficiency of the company, which means it always measuring the firm have liabilities and assets, how effectively these liabilities and assets are used by companies to improve its effectiveness and efficiency. They measures how quickly a company is converting its current asset like inventory and account receivable into cash. And also how it is managing its inventory, receivables, how it's managing its payable, how it is managing its asset to generate more revenue and more profit. So these are the some metrics which is involved in the activities ratios. So the next key ratio is market ratios. These ratios describe a firm financial condition per share perspective. That means or for investor perspective. Like that, if I'm an investor, I would like to invest in a company. So definitely I would conduct some ratios analysis, some analysis to see whether this investment is feasible or not feasible. So the market ratios provide this insight for an investor to see whether this investment is feasible or not feasible and the return prospect of this company, and also to compare this one company's return perspective or the performance with the similar industry standard or similar companies. This include metrics like earning per share, price to earning ratio. These are some of the metrics which covering in the market ratios. It is always focusing on investors' perspective, whether to invest or not invest in this company, this investment is feasible or not feasible, and also what is the return I can expect from this investment. So the other perspective of financial ratio analysis is profitability ratios. This ratio measures the firm's profitability like its GP ratio, operating profit and the net profit, and to see how effectively it is managing its operation, how effectively its selling price point, how effectively it is managing its cost to generate more profits. So the profitability ratio is always measuring the profitability of the business to see whether this business is profitable, or I can compare these profitability ratios with the similar industry standard or the similar companies to see how this company is profitable or what are the areas to be improved to improve the financial performance or profitability performance. So these are the key ratios: the liquidity ratios, leverage ratios, activity ratios, market ratios, and profitability ratios. So in this today discussion, we are completely focusing on liquidity ratios. So what is liquidity ratios? We already discussed. Liquidity ratios are the ratios which use it to measure the liquidity or short-term solvency of the company. That means its ability to meet its short-term obligation by using its short-term asset like current asset. So the first measure is net working capital. Net working capital means how much money company invested to fund its net working capital. That is the net working capital. So the net working capital is the difference between total current asset and total current liabilities. So you can get the net working capital by subtracting total current liabilities from the total current asset. This is a total investment by a company to manage its short-term obligations. That means if a company has some current asset, the firm should invest into the current asset. So to calculate the net investment required or net working capital required to the current asset, you can subtract current liabilities from the current asset. So that will be your net investment in working capital. So another important terminology is operating cycle. A company's need for working capital depends on length of its operating cycle. What is operating cycle? Operating cycle is the time it takes to convert the cash invested in stock and in receivable back into cash. So that means how long the company is taking its inventory convert into sales and the sales converted into cash. So if a company have a longer operating cycle, it will need more net working capital to be invested. Or if a company have a short-term operating cycle, the activities can be managed with a less working capital. A shorter operating cycle means cash generated more quickly. So the company may not need as much working capital. I mean, if a company can manage its activities or its operating cycle as low, which means there is required a low working capital investment, so the company can generate or manage its short-term activities with less investment. Operating cycle simply means the length. It's a time to convert its stock into sales and sales into cash. This is operating cycle. So we'll move into the important ratios, the current ratio. Current ratio is one of the most important ratios to measure the short-term liquidity of any business. Current ratio, the formula for current ratio is current asset divided by current liabilities. How we can interpret this current ratio? Current ratio measuring how much current assets available to me is current liabilities. In some industry, the common standard is 2.1. That means which required 2 current assets for 1 current liabilities. Which can be vary from company to company, operating structure to operating structure, industry to industry can be changed. So as a normal, it is considered 2:1 is as a standard benchmark for the current ratio, but it is not ideal or it is not standard for all industries. It can be vary from industry to industry, by company to company. A lower current ratio generally indicates a liquidity problem, which means the company doesn't have efficient current asset to manage its current liabilities. The other thing, the quality of the underlying asset. Sometimes what can happen, there are a lot of current asset, but can be some of major component is the stock. So we know that stock is generally difficult to convert into cash, or in the receivable there are some type of bad debt are there. So this quality of the underlying asset or quality of the current assets also very important key factor while interpreting the current ratios. So another important ratio is quick ratio. Quick ratio is solving this problem, this quality problem, liquidity of inventory or quality of the underlying asset in certain level, which is removing the prepayment and the inventory from the current asset, and which is calculating quick asset, which is called a quick asset, which means from the current asset, if you remove your inventory and prepayment, so you can get the quick asset. So these two things are very difficult to convert into cash. So the inventory, some case it will take more time to convert into cash, and the prepayment also again there is no chance to convert that prepayment into cash once again. So we are removing these two elements from the current asset to calculate the quick asset. So we are in the quick ratio we are comparing this quick asset with current liabilities. So 1:1 is considered as a standard level. But again, it will change, it will vary from company to company or industry to industry. So if you are making a comparison of quick ratio with the industry benchmark, you will get a better idea. You will get a better idea about the true liquidity position. Next ratio is cash ratio. Cash ratio is comparing cash and cash equivalents with current liabilities, which can be cash and cash equivalent are highly liquid, so it's readily available as cash into business in the business. So if you are comparing, if we are analyzing this cash ratio, like we are trying to compare current liabilities with the cash and cash equivalents, you can easily get the real-time liquidity of the company. That means how much percentage of total liabilities can be set off quickly. Cash ratio formula is cash and cash equivalents plus marketable securities divided by current liabilities. This is the formula for cash ratio. So the interpretation for the cash ratio is very conservative and show companies' abilities to pay off current liabilities using only cash in hand. The cash and cash equivalent mean it's readily available with the company at any time. So how much proportion of the current liabilities can be set off by using this highly liquid or cash in hand? The next important ratio is cash flow ratio. The cash flow ratio is measuring the ability of a company to pay its current liability by using its cash flow. The formula for cash flow ratio is operating cash flow divided by period and current liabilities. The cash flow ratio is a strong measures of liquidity, so which is showing the actual real liquidity of the business. Which means if a company have a lot of asset, maybe it's which may not be equal to the cash which can generate. But in the cash flow ratio, which is showing how much inflow of the cash, then we are comparing that operating cash flow with the current liabilities. So, which means the company can get the real liquidity of the business if you are using cash flow ratio. Next, we are moving into a simple example to calculate how to calculate all these ratios. So here is an example which is showing the current asset of a company. There is a cash of 50,000, marketable securities 10,000, accounts receivable 80,000, inventory 110,000, prepaid expenses 5,000. That means total current asset in this case is 255,000. So the current liabilities also listed here. The accounts payable 10,000, acquired expenses 20,000, short-term debt 55,000, and the total current liability is 175,000. And also the statement of cash flow showing an operating cash flow of 150,000. So now we are going to calculate the net working capital of this company. So what is the formula for net working capital? It is total current asset minus total current liabilities. So it is very easy to calculate. The total current asset in this case is 255,000 and the total current liability is 175,000. So the net working capital is 255,000 minus 175,000. That means 80,000. So it's a positive working capital in these companies, and a basic analysis have, here we can come with a basic analysis. The company have sufficient liquid asset to cover its short-term obligation, which means it has total current asset than its current liabilities, total current liabilities, which means the company have a positive net working capital. It's a positive indicator. So next we move to current ratio. Current ratio, the formula for current ratio is current asset divided by current liabilities. So in this case, the current asset is 255,000 and the current liability is 175,000. So you can see the formula here. Current ratio is equal to current asset divided by current liabilities. So the current asset is 255,000 and current liability is 175,000. So the current ratio is 1.46. So what is its interpretation? Which means every single $1 of current liabilities, the company have $1.46 of current asset. for each $1 of current liability, the firm have equal $1.46 of current asset. So the quick ratio or asset test ratio, it's more conservative measure. This is more conservative measure than current ratio, because in the quick ratio, we are removing inventory and prepayment from the total asset to calculate the quick asset. And that quick asset only we are using for current quick ratio is cash quick asset divided by current liabilities. So in this example, quick asset as we can go into asset list to see the quick asset. Cash is a quick asset. Marketable securities are quick asset. Account receivables also quick asset. But we have to remove this inventory and prepayment expenses to get the quick asset from the current asset. So in this case, this cash plus marketable securities plus and this account receivable, these are the quick asset. So it is 140,000 is the quick asset. 140,000 divided by current liabilities, again 175,000. That means 80.80. So what we can interpret this from this ratio? That means a company can set off or company have 80 cents of quick asset for every $1 of current liabilities, which means the company can set off 80% of its current liabilities by using its quick asset. So this is quick ratio. Next we will move into cash ratio. In cash ratio, we are using only cash and equivalents plus marketable securities to compare with the current liabilities. So in this case, we can see the here cash 50,000 and marketable securities 10,000. These only the cash and cash equivalents. So in this case, it is 60,000 is cash and cash equivalent divided by, we are comparing this with the current liabilities. So the cash ratio is 0.34. This 0.34 indicate that this company can set off 34% of its current liabilities by only using cash and cash equivalents. Or it can interpret in another way, which means company have 34% cash and cash equivalent for every $1 of current liabilities. This is cash ratio. The next ratio is cash flow ratio. Cash flow ratio means the company is comparing its ability to set off its current liabilities by using only its operating cash flow. So in this case, you can see the operating cash flow is 150,000. So here the formula is operating cash flow divided by period and current liabilities. This is the formula for cash flow ratio. So in this case, the operating cash flow is 150,000 and the period and current liability is 175,000. So the cash flow ratio is 86%. So which means the 86% is definitely a strong cash flow ratio, which means the company can set off its 86% of current liabilities by using its cash flow. So we are just summarizing today's discussion. So today we are focused in liquidity ratios. Liquidity ratios measures a company's ability to pay its short-term obligation by using its current asset. Again, we discussed the important liquidity ratios like current ratio, quick ratio, cash ratio, cash flow ratio, and about the working capital. So the liquidity ratio is one of the most important part in CMA USA examination, and also its ratios are very important when analyzing a company's true liquidity performance. If you have any doubt or you need any extra clarification on this topic, please comment on the comment section. I'm giving downloadable link for this PDF file for your free reference. You can download and use this file. Thank you for watching this video.